Let us begin with this. Kind of like Bed Bath & Beyond, it's been a wild 24 hours for your money. Moments after we got off the air last night, the news hit that Iran launched missile strikes on 2 Iraqi military bases that house American troops. Thankfully, nobody was hurt, but the attack sent S&P futures plunging. Then, Iran calmed it down a bit, saying it would stop there if the United States did not launch any new attacks. Futures immediately rebounded, making up nearly all of their losses. The markets open, and they're pretty much flat until shortly after 11 a.m. Eastern Time. That was when President Trump addressed the nation, saying Iran, quote, appears to be standing down. And just like that, stocks surged. The Nasdaq closing at all-time highs again. So, Guy Adami,
yes,
here
sir.
we are, yet another potential crisis, but yet more new highs. What do you make of it?
Well, I think I tried to make this too complicated. I said it for a while. I mean, clearly I've missed in terms of the broader market rally this for quite some time, but maybe it is as simple as this. Maybe it's as simple as if the Fed keeps adding liquidity on a daily basis. Again, we'll say by April of this year, if at current pace, the balance sheet will be at record highs. I think that's madness. It doesn't matter. And the fact that passive investing is a thing and money flows into the market regardless of headline. Now, you know, loss of life aside, I don't even think the market cares regardless whether or not something did escalate last night. I think it's so insulated from outside news that it just seems to go higher regardless.
Hold on, Guy, follow up on that. So what will matter?
I don't know.
The Fed will matter.
Yeah, well, the
Federal
Fed
Reserve,
stops.
and your guy's saying this. I mean, you know, we know that the $250 billion of balance sheet that was basically added at the end of the year, and we also know that we're here on this show to not necessarily talk about the travesty and the sadness of life. We're here to talk about what's going to move markets, and we can have a parade of economists all tell us the same thing. The geopolitics, at least in the short to medium term, don't do anything to change the economic path. And in fact, I'm not going to simplify the trade war down to that, but even that is something that we've had a cascade of economists telling us that that's not changing the path. And the economy is what matters for markets.
Okay, I want to get the safety trade risk reversal, Dan Nathan, because there's all this stuff now on the internet about maybe more stuff over Iraq right now. You don't know. Point is, we are in a nervous market. We should be in a nervous market. How do we protect ourselves? If you are still just, as Guy said, passively putting that money in your 401k, 529, IRA, whatever, is there a way to buy a little protection?
Sure. Well, you know, that's a good question. And I think if you look at 2019, and Chris Verrone and I were just talking about this, we started off on January 2nd or whatever, and we never looked back, right? It was off to the races. That's not a really common occurrence. And if you look at 2019, the S&P 500 did have 3 peak-to-trough declines that averaged about 6.5% or so. Nothing horrible, held that uptrend. Now we broke out in October. We're up about 8%. We make new highs, it seems like, every day. If you're looking at the SPY, a lot of people were looking at the VIX last night when they saw the futures getting hit and the VIX was spiking a little bit. It was never up that much. You know, at the money, S&P 500, whether it be SPX or SPY, puts looking at a couple of months, literally would cost you a couple percent to insure yourself. So if that's something that you're saying, I had a great 2019, I'm not so certain that up 28%, maybe we pulled forward a little equity return given what the headwinds are. And I'm worried about maybe the next time we see bombs lobbed over, maybe there's gas in them. Maybe they're a little more accurate. You may want to have portfolio protection, especially if you want to let things run a little bit and not panic like we saw last night in a lot of different asset classes.
And Dan, I would echo that. I would say the 10-day call ratio is the lowest it's been in about 18 months, right? So there's some complacency out there we have to be mindful of. But I want to make a distinction between a pause or a consolidation and a top. And there's no technical indicators that a top is being put in place right now. You have 80% of stocks above their 200. That is a broad market. And look at the new high list today. It was risk-on stocks, the casinos, LVS and Wynn, the brokers, Goldman Sachs, Morgan Stanley. I think that is suggestive of growth in 2020.
But Chris, the charts reflect what we know, and what is the fear is what we don't know, that this may not be over. We could wake up one morning and have more headlines that are worse. Let's hope not. But the charts aren't going to reflect the geopolitical risk.
I think the question is, does positioning reflect the maturity of what we've seen in stocks over the last 12 or 13 months? The biggest inflows last year were in low-vol stocks. That's where the excess is.
I agree. I think you're right, Chris, and I think the breadth of the market has certainly been impressive since October 3, really, since the S&P's up 12.5%. But what has led the way, even during that time, is the triple Qs. I mean, big mega cap tech is up 6% to the S&P during that time. And to what Dan is talking about, look, I don't think people are worried about, staying even even from last year. I think if anything, what the market worries about with the geopolitics you're talking about, Brian, is that there's not a 10% pullback. There's a 25% drawdown because people look at some of the absurdity of the world, and anyone who's got a mind on 2008 and lived through that believes it can happen again. So if anything, I think it's your 10% out of the money that's really the protection that people should have the confidence to go to sleep and invest in this market is because until the Fed and central banks really start pulling away the punch bowl, this market's moving sideways and we're growing at 2%.
Yeah, it's fair. And you mentioned a skittish market. I mean, maybe correctly, but at 13.5, the VIX was actually lower today. I mean, how skittish is the market with VIX at these levels?
Not at all.
It's not at all. And I think again, I'll say it again. Maybe I'm wrong, probably, but there's a bull market, there's a bubble in complacency. The fact that, people continue to be rewarded, which is fine, for buying markets that seemingly just go up, at a certain point that ends. And I think we're a lot closer to it, but I've thought that for a while.
I want to bring it back home because we're talking about some of this geopolitical stuff. One of the trades that I thought would have caught some steam if we thought that the trade situation was abating and that global growth was kind of coming back a little bit, green shoots in Europe. I would have thought that U.S. domestic names, think about Russell 2000, think about small caps, would have acted a lot better. We talked about the S&P broke out in late October, and it's up 8%. The Russell 2000, the IWM, the ETF that tracks, it's up like 3%. It really lags. It's not particularly impressive. And the only thing that's kind of saying to me right now is that that domestic, U.S. domestic is paying a little bit more attention to the trade stuff. Maybe it didn't abate as much as we think it did in December, and therefore I'd keep an eye on that one.